Hello everyone, my name is Kamal Manocha. I am founder and CEO of PMS AIF World. We are a new age wealth management company backed by data insights and content. We have been running this webinar series by name Crystal Gazing Next Decade of Wealth Creation for Investors. In this series, the objective is to invite one of the most credible money managers from the industry to understand their perspective on challenges and opportunities over next decade. We began this series on 7th of August. In the very first episode of this series, we covered Leaders of Tomorrow, which was covered by Mr. Hiren Ved, who is one of the, who is the fund manager and CIO with Alchemy. Post that, we covered Kings of Capital, which was done by Mr. Saurabh Mukherjee. Then in the last episode, we had done the role and application of machine learning and AI in the world of investing and for global financial markets. Today, we have a very, very interesting session. We had done a study to understand what have been the top wealth creators over last decade from 2010 to 2020. So this analysis was done, on point-to-point returns, where returns of all portfolio management services, all mutual funds, which were in the multi-cap, mid-cap, value focused, all categories were covered. And in across all of these categories, we found in the objective analysis, SISOP strategy, Sundaram's secular India portfolio strategy, has been one of the top wealth creators. So today we have a pride to have amongst us Mr. Madan Gopal Ramu, who is the fund manager with SISOP strategy. And we would like to understand from him, what are the traits of the strategy. And it takes a lot about a leader to come up and build so much wealth. So what have you done right in terms of creating great performance? Over to you, Mr. Madan Gopal Ramu.
Thank you, Kamal, and good evening, all of you. Thanks for coming down for this presentation session, as well as thanks for PMS AIF World to give us this platform to speak about our product to a wider audience. What has worked well with SISOP for the last 10 years or so, which has helped us to generate this long-term return. In our opinion, SISOP, what has helped SISOP to deliver this kind of a return over a longer period is its process-oriented approach to investment. What do we mean by process-oriented approach? We follow certain filters before we sort of decide which stocks to invest. We call internally that SISOP is a technically superior product. We used to compare this with one of our finest test match player in India, Rahul Dravid, who has done well in foreign conditions, tough conditions, compared to even some of the best players in the cricket, in Indian cricket. What is the key strength of Dravid? It was his technique. So that's what we call for SISOP also. It's a technically superior product because it follows certain process before it invests into a particular company. And that, I think, was an important reason why SISOP stood out even during tough market conditions. If you see last 3 years, the pitch in the Indian stock market was not conducive. It was a very volatile period. SISOP clearly stood out in terms of performance. If you go back between 2011 to 2013, even in that period, post the global financial crisis, it was a period of a very volatile market. Even then, SISOP stood out. So in periods like this, SISOP has stood out during tough market conditions. And when you do well over a period of tough market conditions and do reasonably well during periods of bull market, in a cycle of 10 years, you stand out in terms of your performance. And that's the key. The key is to not lose money for the investors during tough market conditions and do well during, even if you do in line with the market during the bull markets, then the overall return made by the fund manager in a longer term period will be much superior compared to its peers. And that's the key for SISOP. And what we mean when we say we are process oriented and SISOP is a technically superior product. we just do three things. First is look at equity investments like a savings product. So what do I mean when I say I look at investments like a savings product? We invest into businesses, not necessarily look at investment into as a stock. So what I mean by when I invest into businesses, we spend a lot of time to understand businesses which can deliver sustainable earnings growth over the next 5 to 10 year time period. So this requires a complete understanding of the business more than what probably known in the market, and look at the business from a longer term picture rather than what is happening in the business in the next 1 quarter or 1 year or 2 year time period. This is very important because here a lot of businesses get differentiated from their ability to sustain growth over a longer period. And minimum the return, the earnings that we expect, the earnings growth that we expect is the return that we want to generate for our investors. So I generally look for companies which look for a 15% sort of an earnings growth that can sustain over a longer period. So a company to enter into our universe, the company has to deliver the 15% earnings growth. And post which we do certain financial filters. Many of these financial parameters are not complex ones, they are simple ones, they are time tested. So for example, we look for companies which have high ROC. Why high ROC is required for a business? Because the business can generate higher returns and redeploy that into the business so that the growth continues. And we look for good cash flow companies, primarily because the profit doesn't simply lay as paper profit and gets converted into cash, gets reinvested into the business. And we look for companies with low debt equity ratios, primarily because these companies will be able to sustain periods like the one we are seeing in the last 3 months when the shutdown period is there, and come back strongly post such crisis. One thing we generally avoid doing is we don't try to buy companies with the hope of a mean reversion. It rarely works. And when I see a lot of my investors, when they give their personal portfolio for an analysis, I find many of them having companies within a sector, choosing companies which are trading at probably lower PE. They are trading at a lower PE for a particular reason. The reason is probably their earnings growth is muted, or there is some issues with the promoters or the management, or there are issues of cash conversion. There could be such issues, and that's the reason why they trade at a lower PE. The expectation that they will mean revert within a sector has rarely worked in Indian markets, and particularly doesn't work when the economy is sort of growing slower than what was expected. In these periods, leaders do well and leaders continue to gain market share. And that's the reason why we lay a lot of emphasis on selecting companies based on certain filters and not just buy companies based on PE or valuation metrics. It's the business which is more important, which is understood well, and then the financials are analyzed, and then the valuations comes into picture. It's not the other way around. So for example, if you look at why these sort of filters help us, see, we cannot avoid a pandemic or a financial crisis. These have come in the past, this will come in the future also. Markets will remain in volatility, stocks will remain volatile, but businesses which have sustainable and superior profitability and good cash flows will manage these kind and survive during these kind of periods and thrive post crisis, and they generally gain market share post every such crisis. You look at what happened with Titan post demonetization. Titan's profit margins, like its net profit margin in the jewelry business, almost will be equivalent to gross margin of many of the jewelers. And during demon, many of the local jewelers went through a tough time and they were fighting for survival. While if you look at that period of Titan post demon, Titan went for an aggressive store addition, expansion. So while the others were struggling for staying afloat, Titan was growing. And that's the key difference of wealth creation between a company which has superior profitability and wealth creation or wealth destruction by a company which has weaker financials. Another example is HDFC Bank post global financial crisis. While all other companies were struggling on NPA issues, PSU banks, even some of the large private sector banks were struggling on NPA issues in the corporate book. HDFC Bank, because of its good underwriting capability, higher ROA, was able to sustain those periods of downturn and come back really strong and gain market share. And that's the reason why HDFC Bank could outperform many of the financial or large private sector banks in that period. I'm not even comparing with PSU banks which have been struggling for a longer period of time. But even among private sector banks, it stood out for this particular reason. So higher profitability, good cash flows, these are metrics which help companies to sustain and thrive after crisis. So we spend a lot of time to understand businesses, and I'll explain that with two examples. Why we selected Trent compared to Urban Fashions or a Future Lifestyle, and why we selected AU Small Finance Bank compared to an Equitas or a Ujjivan in the within a sector, and that will give you some more idea. And before that, I just wanted to cover one more. If you look at in this portfolio, we lay a lot of importance even among mid caps for the large cap companies that we own, like HDFC Bank, HDFC Life, or Titan. The management or the promoter pedigree is well laid out and it's clearly visible, and they are best in class. But when you go down the cap curve, you have to be really careful about the corporate governance record of promoters and the management. So first thing is, I look for promoters or management who are visionaries, who have a new way of thinking, like the way Mr. Rajiv Jain did at Bajaj Finance. And these are outliers, and these are the leaders who define the growth in the future. So we look for such people, but we kind of put a lot of importance on corporate governance track record. One way that you can identify weakness of corporate governance track record in any company that you own, a simple technique that I follow, and I've been doing it for a lot of time since the time I was doing work of analyst and head of research, is I aggregate the cash flows of last 4 years, item by item in the cash flow statement, and then look at how the cash flows have moved, particularly in the working capital side of the cash flow statement. When you aggregate for 4 or 5 years, right, you tend to find out what has been the aggregate cash movement out of the business, either to a related party or to a subsidiary which is non-core to the investment, or to associate company. And this will give a lot more understanding. You can obviously ask management about why this money is getting diverted, and rarely you will find any management accepts it the prima facie. So it's important that when such large cash flow movements happens out of the business and remain unexplained for a longer period, you just avoid those companies. And I think 95% of the time of your decisions would have gone right if you have done that, avoiding companies where cash flows movements have been questionable. Obviously, those stocks will always look attractive within the sector because they would trade at a lower PE, and that's the reason why some of them continue to trade at a lower PE for a very long period of time. I mentioned that we use the financial metrics and the parameters that we use helps us to identify better companies within a sector itself. So let me give an example between why we choose Trend compared to Urban Fashions or Future Lifestyle. If you look at the Trend compared to other two businesses, it was present in the fast-growing segment. The mix of Trend, the best store, was more oriented towards the female categories, which is among the fastest growing apparel segments in India or even globally also. And Trent was betting on his own brand rather than depending upon third-party brands. So it was giving him additional margin, as well as it was giving a good control on the working capital, which is a key metric to measure any retail format. Working capital is the key. Any retail format which misses out on the working capital control generally gets down and starts losing its way. And it's a very important metric. The Trend started understanding the crux of the business from its joint venture partner Zara, Inditex, through its operations in India, where it has a joint venture, and redefined the experience of customers in the Westside format. And any of you who have been visiting Westside 5 years, 6 years back, and in the last 2-3 years will be able to understand what I'm saying. They gave a new experience to the customers, and all this put together led to a higher revenue per square foot, which led to higher cash flows and higher ROCE. As we sit today and look at it, while Arvind and the Future Lifestyle are looking for investors to stay afloat, Trent is talking about expanding stores at an accelerated pace from second half of this year. And that's the key. While the others are struggling for growth, you have a company which is already starting to grow post the crisis. and that differentiate returns in the longer term. One more example, AU Small Finance Bank versus Equitas or an Ujjivan. I was always worried on microfinance institutions as a space to invest, primarily because crisis after crisis for the last 3-4 years, you have right from Demon, you have continuously seen derating in the space. The key is it's an unsecured loan, and particularly the ticket size of the loan compared to the salary or the income level of the people to whom it is lent is very high. It is as high as even 30-35%, which always brings risk to the business. After crisis after crisis, when the unorganized labor market went through crisis, the laborers who were predominantly borrowers in the MFI space, they default, and this money never comes back. The loss given default during crisis for MFI business is higher, while AU Small Finance Bank was in the vehicle finance and the SME business. The loss given default, even in a crisis, is not as high as what it is in MFI. At the time when I was appraising both these companies, both these sectors, it was clearly visible the loss given default was better for AU, and it was the capital requirement is almost same. And now, as I look at back for the last 3 years, there was a continuous derating that has happened in MFI, and the capital requirement has gone up due to the risk, underlying risk in that business. I see similar thing happening in other areas of the financial lending also. Same like real estate lending or many other areas. So it's very important that you understand the business much more closely and take a futuristic view rather than what is currently being presented. And that enabled us, and AU obviously makes a higher ROA in the business and low credit cost. And Sanjay Agarwal, the promoter, has been very futuristic in terms of his thinking and ability to do business, and superior growth has always been there. And that differentiated between what you see performance of an AU Small Finance Bank compared to Equitas or an Ujjivan. I think even in the future, the capital requirement for MFI businesses are going to go up, and that will continue to keep the valuations compressed for MFI businesses. So these are certain views that you take based on your deeper understanding of the business, and also following some of the financial metrics like return on assets, return on equity, credit cost ratio for a bank. This becomes really important, and paying attention to this are also very important. See, we are here for playing a longer innings, and you might be surprised to hear that Rahul Dravid has faced the most number of deliveries in the test match in the history of Indian test match players, even more than Sachin Tendulkar. So we are here for a longer term, and we would want to play it over a longer term, and following processes over a longer term helps us to sustain this performance over a longer term period. Finally, I would like to mention one more reason why a SISOP sort of product works well is, you know, this word inertia. Inertia has a lot of importance in our culture. Be it meditation or a fasting, which are part of our culture. Meditation helps to rejuvenate our mind, and fasting rejuvenates our body. Both these are essentially about staying still. In the last 3 months, when there was so much of noise levels, staying still would have made a lot of difference to the investors in terms of the return. I think periods like this and crises like this, staying still would be a great option rather than reacting to it. And we followed it in part of it, and we found benefit of it as we recovered from this market fall recently, and then came back strong. I think investors also will do well by, at times when things are going beyond our control, reacting to it might hit us very badly. Staying still might help us actually. So I think these are the principles that go behind investment philosophy of SISOP, which we call it as Sundaram India Secular Opportunities Portfolio. And I think in the future also these will be followed steadfast, and that will help us to generate superior returns for our investors. So back to you, Kamal.
Right, Madan. So, while I'll be talking, just kindly keep your thing on mute. Otherwise, for audience, it leads to some disturbance.
Sure.
You can mute yourself. Right. So, it's a very good detailed analysis and insight that you have shared. For everybody's understanding, I will just, repeat because there was a disturbance in the initial beginning. Now that Sundaram India Secular Opportunities Portfolio has been one of the top wealth creator portfolios, and it is an objective analysis whereby the portfolio has generated 20.70% return over last 10 years. The portfolio was started in February of 2010, and till 31st July 2020, we are saying the returns are 20.70%, which basically means around 6.5 times over a period of 10 years. Right. So, Madan, so now, this is a question for you. Right. So, we understand that diversification to an extent is very important. And Warren Buffett, has coined this phrase where he had said that diversification beyond a point is kind of a fool's paradise, or it is a protection against ignorance. Right. So, my understanding is that the portfolio, SISOP portfolio, is highly concentrated, and concentration over a longer period of time has added weight to its journey of wealth creation. What are your thoughts in this regards? Kindly elaborate.
You are able to hear now?
Absolutely, yes.
Yeah. So, yeah, I think it's a relevant question, and particularly in the last 3 years, there has been a clear differentiation between um, diversified mutual funds performance and the concentrated funds performance. And CSOP is a product where concentrated investment philosophy is followed. We invest around 15 stocks at any point. The reason why we chose a concentrated approach to investment is one is, I think, in an Indian context, the number of companies which can deliver superior earnings growth and simultaneously able to deliver it over a longer period of time, and also have a superior financial metrics like the metrics that I laid out, with good management, all this put together. When you put all these filters together, the universe comes down to not more than 40-50 stocks. And many of these stocks at a point of time trade slightly above valuations which we are comfortable with. So, in addition to the metrics that we laid out, and then giving a real good view on the valuation also, because we should not end up in buying companies at a real high valuation, and that leads to consolidation in the stock, in the companies, in the products performance over a longer period of time. So the valuations are also becomes important post the entire analysis on the businesses and the financial metrics. So from this basis, when we select, I think the opportunity comes down to as low as 15, 20, or even 25 stocks maximum. And that's the reason why a 15 stock portfolio with a concentrated approach towards investment helps us to identify companies which can sustain these kind of performance over a longer period of time. And importantly, diversification has become a major risk in the last 2-3 years, as the Indian economy was slowing down from a 7 to 8% economic growth rate to around 5 to 6% in the last 2 years. The number of performers are also have come down quite sharply. So in this period, if you are running a 50 stock, 60 stock portfolio, your top 10 stocks might be doing well, but the bottom stocks, they really drag your returns out. And that has been one reason why many of the funds have struggled also. So it's important that you approach with a concentrated nature. And also, when you have high conviction idea, when you have done your research on a stock, when you know what is the how the things are panning out for that stock, it is important that you put a disproportionate weight on the stock. Buying a 1 or 2% of that stock really does not make any difference to the investors when it comes to the return. So when we identify trend, if you look at the trends weight on the overall portfolio, we started with the 6% to 7% sort of a weight. Trends weight in the NSE 500 is even less than 1%. So we don't even look at the benchmarks. When we look at the businesses and we like those businesses, we put disproportionate weight on those businesses. And when those ideas work, it brings higher returns to the investors. And this is possible when you run a concentrated portfolio rather than a highly diversified portfolio. So if you do your research well, identify the right stock and put a disproportionate weight on the stock, then the returns to the investor also might be much superior compared to the overall market returns. And that's a key for SISOP's concentrated approach towards investment.
Right, Madan. So going by the performance of the fund, definitely long-term performance speaks about it. It's one of the best in the entire industry across mutual funds and portfolio management services. However, the medium-term performance, when we talk about 2-year, 3-year, and 5-year performance, that certainly is, in better than its benchmark, which is, Nifty 500, right? Also, equally as good as maybe Nifty, but it's in single digits. It's around 5 to 7% on year basis for 2-year, 3 and 5 year. 1 year performance is again very good. I just analyzed that while you were saying the 1 year performance of Nifty 500 is negative around 50 basis points, but for SISOP strategy it is 13.70%. Right, but if we talk about say 2-year performance, 2-year Nifty 500 is negative 3.20%, and you are up by 2.30%. So an alpha of around 5.5% that you have generated. And in 3-year also, there is an alpha of around 6%, and 5-year, there is an alpha of around 1.5%. But certainly the returns over 2, 3, 5 years are between 3 to 4 to 5% or 6%, not more than that. But the 7-year returns and the 10-year returns are very high. They are the ones which are between 18 to 20%. So, given the entire thesis that you have explained, right, in terms of your stock selection, in terms of sector selection, in terms of avoiding mistakes, in terms of deep diving the numbers, avoiding corporate governance issues, why is it that returns over 3-year, 4-year, and even 5-year are not in double digits? You are on mute.
Oh, sorry. One thing we need to keep in mind is a period when we are talking is just after a crisis. There has been some changes to the portfolio that has happened in the last 3 months or so. If I go back a little bit and look at the February month return just before the crisis started, we were having a healthy double-digit return in SISOP from 2 to 3-year perspective. Even 5-year was closer to a double-digit sort of a return, even higher return. There was a period in 5 years back when the portfolio underwent some bit of a correction because we invested with the hope in some of the stocks about the India shining story, and some exposures in the capital goods, some exposures to the energy baskets had led to some bit of an underperformance for a short period of time. And post me taking over, we went back to the basics. We stuck to the basic philosophy of SISOP of investing into companies with sustainable growth, and that started reflecting into the portfolio over the last 1.5 year period or so. Last 3 months has been a tough period because we had a very high exposure towards financials and consumer discretionary, and I will cover that when we talk about the themes for next 10 years and why we continue to believe that these are very good themes to play out. There has been a sharp correction in the financial names as well as the consumer discretionary names. But within the space, that stocks that we chose, they have come back now really strong. Say, for example, HDFC Bank has come back to almost its the pre-COVID level compared to, say, where the IndusInd Bank is or where the Yes Bank is. That's the key. Like, even though we were in sectors which have got major impact due to the corona impact, which is a short term in my opinion, and things will recover over the next 1 to 2 year time period. But despite that, we were able to come back and bounce back quickly. And the reason for that is the stock selection that I referred to. Even within, as I was highlighting, even within the consumer discretionary space, trend, although it has corrected from its peak, it's still from a 1 year perspective has generated maximum return to the investors in that space. Same thing with, say, Titan also. Titan has managed to deliver very good return over the last 3-4 years, despite slowing down economy, slowing down income levels. But these are these are the reason for their performances, as I highlighted to you, is the sustainability and the financial superiority of these companies compared to its peers. And the last 2-3 months recovery we are seeing, and the best is yet to come for SISOP, in my opinion. As I look forward over the next 2-3 years, alignment towards consumer discretionary, alignment towards the financial space, but being with the good names in these sectors would help the investors to reap much higher benefit compared to overall market. That's why I say, even though we have come back in the last 2-3 months, the best is yet to come for SISOP as the story on consumer discretionary and financial sector plays out. So I agree to your point that a 5-year return, the alpha is lower, and that's a period when we bet on this India shining story, and that led to some underperformance. But we corrected our path, and then we came back. We started investing into companies at the time, and since I took over, and we have made some changes to the portfolios also posted. And the benefits of that we're seeing through for the last 1.5 years or so. So keeping the corona impact away, I think the portfolio was coming back and delivering the double-digit return, the 10 to 15%. It was actually closely coming almost closer to 15% return before the corona impact happened. And we are heading back towards it. And as I see today, the returns for 5-year also are looking up, 3 years are also looking up. And the best is yet to come, actually speaking, because the portfolio is aligned towards this recovery phase post-corona.
Right, Madan. Thank you for your. Just kindly, mute your thing. Right. So now we'll be doing, a few questions and answers. There have been very insightful questions that have been asked by the audience, and I will take one by one. The very first question comes on your view with regards to chemical sectors. So there are the universe is large. There are many names, and the view with regards to chemical sector is very positive. And what are your views in this regards? And are there any companies in your portfolio? Kindly unmute yourself.
So I'll cover it as part of one of the key themes that we play in our portfolios, the Make in India theme, actually. While many of us have not seen the benefit of Make in India in a bigger way so far, but we were observing that government was taking steps on an incremental basis towards reaching this objective of Make in India. I'll tell you why we saw this happening. Slowly and steadily, government was imposing import duty on many of the imports that we did. And we were seeing that happening in the consumer electronic space. And we were also seeing that government was encouraging setting up of chemical industries in India during the period when China was getting into trouble. China was kind of closing down many of its industries on pollution control measures. And that led to some of our specialty chemical names as well as the chemical companies get a decent headway in terms of new projects from MNCs who wanted to de-risk and avoid the risk of lack of availability of raw material because of this. One is the trade war that is happening, and second is China is going through this pollution control measures, as well as China is also in a sort of a belligerent mode compared to its neighbors and to the global powers. So the risk of losing out on raw material availability was already playing out in the minds of MNCs. So they were looking at opportunities, and I think government started taking some efforts in the past itself to attract such investments to India. One is GST. Obviously, many of these international companies want GST for their domestic operations. Second is the corporate tax rate cut last year, which incentivized setting up new facilities. And now, of late, government has started talking about the PLI scheme, which is about incentivizing domestic manufacturing. So I think the efforts have been coming for the last 3-4 years. Under this theme, we played one specialty chemical more from an export opportunity point of view. And we played another, which is an electronic manufacturing in India. And both these stories have played well in the last 2 years or so. And I think they have a reasonable headroom for the next 5 years also, because the manufacturing, the Make in India theme has never really worked post the government took over. But the slow and steady measures that they have been taking, in addition to the recent accelerated measures that they are taking, I think that's a theme that looks good from a next 5-year perspective. From a specialty chemical point of view, what we hear right now from many of the chemical businesses, I'll give you an example of PI. Why we choose PI compared to even other companies was PI was clearly a standout from a perspective that they were working with innovators rather than they are not betting on commodity chemicals. They were betting more on custom synthesis and say working with innovators globally. And therefore, once a product commercializes and gets patent, you have your revenue for a longer period of time. So success of every product of PI was a great addition to its growth story. 2-3 years back, if you look at PLA used to do 25 new molecules and then used to get around 2 to 3 of them commercialized. Today, as of last financial year, at the end of the last financial year, when they disclosed the numbers, they have got inquiry pipeline of around 70, and they are confident of coming out with 5 to 6 new molecules every year. And now that's a major growth opportunity, right? From a 2 to 3 to almost 6 sort of new molecules getting commercialized every year. It's a huge growth. And looking at the opportunity, PA was continuously expanding its capacity. We played it through PI directly as well as through GMM Fowler in one of the other portfolio, which was a capital equipment supplier for PI, SRF, and other pharma companies. So this chemical space looks attractive, but the investors have to be careful. I see all chemical companies moving up much sharper. It is very important to understand that some of them might be benefiting from the current health crisis which is there globally and may not sustain for a long period of time. Spend time on understanding the businesses and be with companies which have high value addition in this and not necessarily benefiting from the chemical price movements. If you remember, 2017 also we had a chemical rally for a very short period of time at the peak of market, and then post that the chemical companies saw a major correction also. So if you invest into commodity chemical companies just because of the realization of those chemicals going up due to a short-term demand, which generally happens during crises like this, then you might get stuck to some of the names, which might lead to a loss of value also. Important is to understand the companies which are adding a lot of value to the MNCs from their research point of view and are adding value by cost saving metrics. Those are the ones to bet. And there are 10-12 stocks in that way. Some of them are available at attractive valuation even now from a longer term perspective, and bet on those. And that's the key in the chemical space. While on the manufacturing Make in India electronics, the kind of effort that the government is putting out right now looks really impressive. It seems to be taking a final say shape already with a lot of announcement on mobile. I don't know how many of you know about this. 4 or 5 years back, we used to import even fans which are there in our home as a country. We have come a long way from there, and now a lot of manufacturing is being talked about even for smartphones. Every day we are hearing Apple to Samsung to LG sort of announcing domestic manufacturing plans in line with their requirements from global companies. And a lot of investments are being talked about. And I don't know how many of you know this. In India, every year 20 crore smartphones are sold, and companies like Xiaomi, Oppo, Vivo, all these names which we see around us, each of these companies have a turnover of above 30,000 crore. So the domestic manufacturing is a great opportunity in my opinion. If the government takes it through, initially it will be more of an assembling work, but slowly as the volume picks up, we will get into manufacturing of the components. That's a 3 to 4 year sort of story in my opinion, and I think that's the space to look out for. So in addition to chemical, I think electronics we played for this Make in India theme, and both worked well. And I think next 5 years also there is a good story in this space, and looking forward for more opportunities there. And so that's a theme that investors should be conscious about. But always pay attention in this while selecting the companies, because I see companies with low financial quality, as well as companies with very high quality of financials. Pay attention to asset turnovers, working capital terms, and the return ratios, because when it comes to outsourcing, it is important that the outsourcing is done at a higher ROCE and with low working capital. Companies which are not able to do it is a reflection of the weak business. So to understand whether a chemical company is a value-adding company or a non-value-adding company, if you pay attention to its working capital and its ROCE, you will get a nice view into what that company is up for. So please pay attention to these when you select the companies.
Thank you for your suggestion and advice, and really value your views. In such a detailed manner, you explained about the specialty chemical sector and how to select a particular company. So what are your views with regards to Reliance Industries? I do not see that stock in your portfolio, and of late, many portfolio managers and mutual funds specifically have added Reliance as one of their top stocks. But if this is missing in your portfolio, any particular reasons, and what are your views in this regards?
So Reliance, I think the turnaround in the telecom space was an interesting one that happened over the last 2-3 years. There was a lot of question marks because the company is. So the reason why we kept Reliance out of our investment is because of the process that we follow. As I highlighted to you, we wanted a minimum amount of ROCE. So Reliance ROCE has improved, but has still not reached the level which SISOP has a. And that is one reason. Second, I mentioned a lot about cash flow conversion. Since it was a mix of all the three businesses, it is very difficult for you to judge whether the Reliance retail business, which is currently getting a very high valuation in the SOTP, is it really generating that much of cash, which is difficult for us to understand from the financials that is being reported. There is a lot of movement of cash. And that brings down to that call of whether the cash flow conversion from the P&L account, is it happening to the extent that we would like to. There could be many reasons of money flowing between three different businesses. The prima facie, three different businesses with three different financial metrics and three different sort of cash flows getting consolidated and reported itself is a very big issue for us from coming to a conclusion on each of the businesses from their return profile as well as cash flow generation. And it's a very tough task to come to a conclusion. I'm not saying there is something to be doubted, but it was very difficult for us to come to a conclusion. And that's one reason why we kept out from this portfolio, because this portfolio clearly has this laid out principles that a minimum ROC of 15%, minimum sort of cash flow conversion of 50% of the EBITDA, and then low debt equity ratio. Although the debt equity ratio has come down now, that has happened more from the back of a monetization program rather than the cash flow generated from internally. That is one very important criteria that we follow from a stock selection point of view. The monetization gives a lot of comfort to the investors. I agree to it, but the debt reduction happening more from an internal cash flow generation is a very important criteria to judge the quality of business from a longer term perspective. The mix of businesses of 2-3 businesses itself makes it a very complex company. And in SISOP, we have tried to avoid complex businesses and try to keep it very simple, easily understandable businesses, and easily measurable companies, which is very important. We need to be able to measure it. Although periods like monetization of investments in the past leads to turnaround stories, SISOP doesn't play those turnaround stories unless the turnaround is so strong that the fundamentals of the business changes financially. That's a key criteria. So even Bharti, a lot of people question me. I say Bharti is turned around and we have it in another portfolio of ours, but still not reached the ROCE metrics that we follow. And we have a 5G capex also coming up, if not in next 1 year, in 2-3 years down the line. So how will the ROC of the telecom businesses will look like once the capex mode again starts? Today they are not in capex. They have done with their 4G, and now they are looking at reaping the benefits of it. But how will things look at when they start with the 5G capex? Because China is investing heavily on 5G. If we don't do our 5G capex, we can postpone it, but if we don't do it, then competitors of India's manufacturing at some point of time versus in China or other global peers will come into picture. So it's important to keep these things in mind when we bet. This product doesn't buy into companies which have lower return ratios and lower cash flow generations, and that's the reason why we kept out of them.
Brilliant. Yeah, so it's quite understandable. So, as the name of the portfolio says, Secular India Opportunities Portfolio, it's comprises of secular businesses, those businesses, whose earnings can be predicted, and avoids turnaround stories, the examples you took, right? So that is, quite easy to understand. And also, the other portfolios which would follow turnaround stories as one of the elements of the portfolio will follow it with more diversification, right? So you are following high conviction philosophy in secular businesses, and hence you are taking a risk of very confident bets. That is where it is high concentration, and that is the reason maybe it's turned out to be one of the top wealth creators over the last 10 years. So in the context of the secular businesses, which are predictable businesses, what are your views with regards to the two new businesses which many portfolios have added of late? I think you have also added. You can confirm that. One is HDFC Life Insurance, and second is Avenue Supermart. So when you said that you do not want to add any complex businesses, easy to understand businesses, right? What are your views in this regards with regards to these two companies? You're on mute. You have to unmute yourself.
Thanks for that question. I think retail has been one of our major bet, and which turned around, which did really well, right from Titan where we made money, followed by Trent, and I'll cover your Avenue Supermart first, and then go to HDFC Life Insurance. Why we picked the stocks. So retail is one of our major bet, and I think it's a next 10-year story. To put things into context, if you look at over the next 10 years, as the income level, even if it is growing at say 6% or so, you will find people who are between the income level of 4 lakh to 10 lakh, which is ideal income level to start spending on discretionary. The households which are there in this bracket level will move from 6 crore households to almost 20 crore. Okay, because of Corona, there could be a slightly lower expansion in this number of households, but still there is a clear chance of the number of households with an income level of 4 lakh to 10 lakh kind of doubling in the next 10 years or so. So what these guys are going to spend on when you reach income level between 4 lakh to 10 lakh, if you observe around you what these guys spend on, see, by the time they reach this income level, most of their basic necessities are done with. Most of them would have already met with their FMCG sort of requirements are already addressed. What they incrementally spend more, they spend more on food, which is packaged food or QSR format. They spend a little bit more money on branded apparels. They clearly move out of unorganized brands to organized branded apparels. They also spend a lot of money on entertainment. India is an entertainment starved country, so they spend a little bit more on entertainment. And fourth, they spend a lot of money on protection, that is safety, with either it is in the form of insurance or in the form of healthcare. So they spend a little bit more on that. So these four items, which we call as low ticket consumer discretionary, these are not high ticket consumer discretionary, and they don't depend on very high level of income growth. These are low ticket consumer discretionary. When the number of population who can spend on these from an income perspective keep increasing, and simultaneously with companies like Bajaj Finance, who are providing say innovative way of financing these purchases when it comes to say mobile purchase or a durable purchase, consumer durable purchase, the things become much more interesting and growth becomes little more interesting. If you observe last 3-4 years, and it's already playing out, it's not something which I'm saying is going to play out in the future. If you observe what is happening in the last 3-4 years, look at the volume growth of hair oils, soaps, detergents, fairly penetrated. Single digit or even lower single digit sort of growth, volume growth. Biscuits, except for this corona, Britannia was struggling at 5 to 6% sort of growth for almost 3-4 years now. So what was growing really? Consumer durables were growing. Retail companies were showing superior growth in this period. They had SSG growth equivalent to volume growth in addition to store addition. So the growth rates of the consumer discretionary, QSR formats, consumer durables, these were actually picking momentum. It was happening last 3 years itself, and it will continue to happen in the next 10 years also. There will be a small blip due to this corona impact, due to the lockdown, which is more of a forced lockdown. I don't think structurally anything will change to some of these behaviors. People will come back when the threat is behind us. And over the next 10 years, if you ask me, areas that you have to bet, assuming a 6% sort of an economic growth rate, I think consumer discretionary looks really attractive, and retail is an important aspect of it. When you look at retail companies, two metrics decides their revenue. One is the SSG growth and another is the store addition growth. The same store sales growth, which is the SSG growth, comes depending upon how good is the format and how well the product is positioned. Like if you look at a trend, its SSG growth is almost 8 to 9%. If you look at DMart, its SSG growth is even above 15%. And there is a reason, I will come to that also. There is a technical reason also. This SSG growth itself is giving a 10 to 15% sort of a growth. On top of it, minimum 10 to 15% comes from store addition. Put together these two, the revenue growth of a DMart or a Trend is as high as 20 to 25%. Compared to our FMCG companies, which are struggling for single-digit growth. Some of the FMCG companies are outliers. They do 10 to 15% growth, but not many of them. So clearly, as a space, given the consumption basket moving up for the population in India, consumer discretionary and particularly the lower ticket consumer discretionary looks pretty attractive from a growth perspective. And particularly the retail companies, which are more urban centric, their SSG growth plus the store addition growth is driving almost 20-25% revenue growth. Even if there is no margin expansion, you can easily get anywhere between 20 to 25% of earnings growth. If you look at where the store addition is coming from, if you look at where these guys are adding stores, I have done some work. I looked at from a population perspective, where all a number of stores that can come under each category. So we split the cities into tier 1, tier 2, tier 3, tier 4, right? The opportunity lies more in tier 2, tier 3, tier 4. And if I look at DMart, they even have operation in a tier 3, tier 4 city with population of less than 5 lakhs. And they have something like almost out of their 200 stores, they have almost 30-40 stores in tier 2, tier 3 and tier 4 cities. So if I do a rough max on number of stores that they can put in every segment of cities, like a tier 1, how many, tier 2, how many, if I do rough math about it, I think easily these can double or triple the number of stores over the next 5 to 6 year time period. Same thing for DMart, same thing for Trend, same thing for Titan, they can do it. And why they're able to do it compared to other peers? Because they have a balance sheet which can support, and existing stores are delivering a return ratio of above 20%. So they can put back this money into the business. And I'm talking about cash return on capital employed, cash ROIC, I say, which is calculated by dividing the operating cash flow to the capex that is invested in each store. If you look at it, it is 20% for each of the companies that I've invested. So that gets redeployed into new stores. Every store takes anywhere between 1 to 2 years to reach the maturity. And once they reach maturity and start delivering returns, that gets reinvested into the new stores. So new store addition growth continues at around 10 to 15%. Then you have companies which can do revenue growth and earnings growth of above 20%, which is very rare to find in an FMCG format. And that's one reason why you find me more into consumer discretionary than into consumer FMCG. And I think next 10 years, this story will play out. You have to stay put for the next 3 months or so when this lockdown situation eases and stores start operating. That's why I said the best is yet to come for SISOP. And because some of these bets are yet to completely deliver on my expectation in terms of returns, and that will happen over the next 1 to 2 year time period. When it comes to HDFC Life Insurance, I added it recently. One is I wanted to reduce a bit on the banking lending space from an diversification point of view. We had a very high exposure towards banks and lending companies. So we came out of Chola Finance. We had an issue of looking at the vehicle finance space going through further deterioration, because one sector which was struggling to grow for the last 2 years in India is auto sector. And the post-corona, I think the issues will turn much more difficult for auto sector, not just in India, even globally also. Auto sector is going through a tough phase because of slowing economic growth globally. So vehicle finance as a space itself might become difficult, and particularly if you are excessively oriented towards commercial vehicle. So we came out of that business and we invested that into a non-lending business, which is a life insurance business, because every such crisis, like particularly health crisis hits, the penetration levels of life insurance and health insurance goes up, because protection as an so in India, if you look at the protection plans, the penetration levels are much lower, because people don't appreciate the need for protection plans in India. And I think insurance is seen more as savings product or more as a return generating product like a ULIP, not as really as a protection product. So with this crisis, our expectation was the protection products will grow and they will have higher margins, and it will be next 2-3 years where you will see growth in this protection business, and that will help the VNB margin of these companies itself go up. So that's the reason why we went into HDFC Life. We are also positive on SBI Life, but HDFC Life as a franchisee looked much better to fit into the SISOP portfolio, primarily because if you look at HDFC Life's VNB margins, it's the best in class. They make around 25% compared to 20-22% of others. And in terms of growth, they keep on coming out with new innovative products in the non-par savings category, and that helps them to keep gaining market share. In addition to it, they have an excellent digital platform which helps them to gain market share. And you can see that happening just after the crisis. With their superior digital footprint, they are already growing faster and gaining market share compared to others in the private sector insurance space. So I think that's the reason why we went into HDFC Life.
Right. So coming to your sector allocation, top two sectors in your portfolio are financial services, one at maybe 38%, and second is consumer goods, which is 30%. So both you have discussed already. What are the other, the third largest sector in your portfolio is pharmaceuticals, pharma and healthcare together, which is around 13%. What does it comprise of, and what is your view on this third largest sector in your portfolio?
Sure. So thanks for that question. Actually, it is a spillover of the consumer discretionary thing that I talked about, right? As people income level increases, protection or safety becomes an important one, and people's ability to spend on healthcare increases considerably. So if you observe, domestic pharma has started getting more interesting in the last 3-4 years from the growth perspective, particularly chronic. So we have AstraZeneca in our portfolio. AstraZeneca is a player who's present in diabetology, oncology, and cardiology. All the three categories where the number of patient increase in India is substantial, and the growth of from a growth perspective, these three segments have been outgrowing the overall pharma space in India. And if you look into it, we bet on the MNC rather than a domestic player here. Again, that's the differentiation we want to bring into the portfolio. We always lay a lot of emphasis on the sustainability, and sustainability comes from technology superiority or a moat in the business. In case of AstraZeneca, is the technology superiority, and all of us know if you see the AstraZeneca global, the kind of pipeline that they have in the oncology space, in the cardiology space, and in the diabetology space is very healthy. And you can see every year they come out with at least 1 or 2 products keep on gaining market share. I can go into detail, but it will not be the time. The time will limit us. But what is important to note is AstraZeneca is a domestic. It's an MNC player focused on domestic market, not necessarily an export company. But the domestic market is growing faster in the patented drug consumption space. So people are, with the income level going up and with health insurance penetration being higher, people are now looking to spend more on the patented drugs, which are very costly. But the efficacy of these drugs are proven, and therefore penetration level of these patented drugs, in my opinion, will grow higher, and therefore growth of these will always outstrip the growth of the domestic pharma companies in that way. And therefore, and also the segment that they are present in, which are the fastest growing segments in the overall pharma space itself in the domestic market, and the pipeline that they bring. And I think it's a multi-year story. You should not be evaluating these businesses based on a quarterly basis. They keep on launching some interesting products, and these products, when they get marketed and then reach a particular stage, they can add meaningful level. If you look at AstraZeneca India to the overall company, it's minuscule. In India, they don't have presence at all. It is sub 1,000 crore company. Globally, AstraZeneca is the fastest growing company and have a revenue above $30 billion. So their presence in India is hardly anything. So it's a multi-year story, in my opinion. And I think our bet on domestic pharma, we wanted to play through an MNC. We liked Abbott, we liked AstraZeneca, but Abbott was one, valuations was very high, as well as some of the large selling drugs in the Abbott portfolio was showing signs of peaking out in the last 1 year or so. And if you look at the AOCD data, you will see that. While in case of AstraZeneca, we have found the impressive growth in all the recent launches in the oncology space, as well as so one of their product has gone off patent, which has temporarily hit their growth for the last 2 quarters. It might continue for 1 more quarter, but actually the growth in the oncology product space, as well as their diabetology, will be pretty good over the next 4-5 year time period. And that's the reason why we bet on that. And in addition to it, we have Metropolis, a diagnostic company. If you look at Metropolis from a financial metric point of view and growth point of view, it will be no way lower compared to Dr. Lal Path, even despite having a mix of B2B business in it. But it was available at a reasonable valuation because of a very large portion of pledged shares. We are cautious about whenever promoters' shares are pledged. But in this case, the pledge was happening because of the promoter buying out the stake from one of the PEs before the IPO, and therefore they had to have a higher pledge to fund that purchase. And they have come out now. Now the pledge numbers have come down. So from the business point of view, we were seeing that it was not anyway different, and ROC numbers, growth numbers, all were looking better. Cash flow generation anyway in this business is better. A slightly higher working capital, but not too much to be worried about. But overall, it is not very inferior compared to Lalpat Lab. But valuation-wise, it was available at a much compelling value. And that's the reason why we bought it into SISOP. And that has also turned around well. And I think diagnostics as a space with more people getting health conscious is a space to watch out. It can easily deliver you anywhere between 15 to 20% compounding year-on-year basis, because there is a huge unorganized market, not so certified diagnostic market, which is up for grab, and most of them would be in trouble in the corona period, and it will help companies like Lalpad or Metropolis to gain market share. So one is, overall we feel healthcare spending by the overall population will be much superior in the next 10 years. They will spend more on patented drugs and health fitness and all those stuff. So it becomes handy to invest into a diagnostic company as well as the MNC pharma company present in India.
Right. So one thing is quite understandable. Yeah, one thing is quite understandable that your portfolio comprises of real businesses, brick and mortar businesses. Because maybe you are only wanting to invest in those businesses which have secular predictable earnings as you shared. But why is it that your portfolio ignores digital space, IT space, or platform based businesses? I don't see that in your portfolio. Kindly
I think there is a change recently. So I avoided IT as a space for two reasons. Um, you look at the IT. Let's take big companies like TCS and all. If you leave the last 3 months performance, because that's a period where I think a lot of changes that have happened, and okay, you can include that also. But if you generally see the earnings growth of IT companies, it was in single digit, correct? So so when I want to deliver a 15% return to my investors on a sustainable basis, on what basis I can go and buy a company which is generating 7 to 8% earnings growth? And if you look at last 3 years, TCS earnings growth is also only 7-8%. It was a leader in the market. No questions about management capability, no questions about business quality. Everything is good. But the place where it falls out, and that's what I said, a process-oriented approach. I want companies with 15% earnings growth. Why? Because I want to deliver 15% return to my investors. I'm not betting on stocks getting re-rated or derated. I'm just betting on stocks at least getting same valuation 5 years down the line as it is right now. And earnings growth should take care of my return to the shareholders. And if stocks get re-rated, good, the investors will get more than what I expected the investors for. But I should not be in a position to buy a company which is growing only at 7-8%, but hoping for a re-rating story or a upgrade in the guidance in the future. In IT companies, we are not going to see any dramatic change quickly, right? It's not going to happen overnight because it's fairly traditional businesses. I've been there for a longer period. They played out the global penetration story, and now the growth rates have come down, and likely so for it will continue for some more time. The growth rates might be in 7 to 8%. What helped these companies to make better returns to the investors? Every time in a period of 5 years, rupee depreciates by 25% in one go. In these periods, their earnings growth is much superior. So indirectly, if you are betting on IT, it has come down to that calculation. One is 7 to 8% earnings growth, which is they will deliver for sure. But I have to hope for this 25% rupee depreciation at some point of time. Otherwise, I will end up buying TCS and consolidating it over a longer period. And TCS was consolidating at the same price for almost 3 years before we entered into this small rally that has happened now from their last peak. And that's the reason why I kept out of IT. But recently, I've added Mindtree into my portfolio. And the reason why I've added Mindtree, post-corona, work from home has become an interesting area of operation. And a lot of companies are talking about savings, cost savings through work from home culture. Cloud platforms are getting penetration in a big way. If you look at the growth of Amazon Web Services and Microsoft Azure and Google Cloud Platform, it is above 40-50% for the last 3 years or so. Very impressive growth. And with more sectors like BFSI has been generally avoiding cloud penetration. They were afraid of data getting shared. But now, because of Corona, the largest spender, IT spender globally, has started looking at cloud as a space because they want to approach most of the customers, and they tasted that during the lockdown period. So now they are spending on the digital side, and they want to transit to the cloud platforms. And we are seeing an increased level of activity in these three, in the digitization as well as the transmission to a cloud platform across many companies, and because of the work from home culture. And I think it is a next 2-3 year story clearly, which will play out in a nice way, or even beyond that also. But we need companies who are predominantly having presence in cloud as well as digital. So Mindtree gets 60-65% of its revenue from cloud and digital presence, compared to others who are much lesser, around 20-25%. So that made me interested in Mindtree, and we invested in it. There is one more company which we will probably you will see it in the portfolio, which looks interesting. But we are very conscious about which business, and that's why I'm telling you again. I did not just decide looking at what is happening globally. to become very comfortable with IT companies and go and buy all the IT companies. I am looking at growth only in the digital space and in the cloud platforms, and companies which are betting on that and their business is predominantly based on digital. Those are the companies to bet, in my opinion. And that's the reason why we went into Mindtree. So Mindtree is the first IT company that I bought in my portfolio post taking over the portfolio management. So we are also, so it's not that I completely avoid these spaces. We look for companies which will deliver that minimum returns that we expect for on the earnings growth perspective.
Right. This is the last question. So your portfolio has around 54% into large cap and around 50% into mid and small cap. So, when we are saying that you are looking to invest in secular businesses with predictable earnings, right? So kindly, give a few examples. Maybe you can repeat names in the mid and small cap space, which have predictability of earnings and which are secular businesses and are available in the mid and small cap space, because your portfolio has 14 stocks, out of which 50% is into mid and small cap.
Yeah. So if you look at the history of SISOP, clearly the outperformance period were all driven by identifying high quality mid caps in the portfolio. If you go back 5 years back, the kind of names that used to be, those were the periods when the returns of SISOP portfolio was substantially higher than the benchmark, not in terms of 3%, 4%, or even 10%. There were periods when SISOP has beaten the benchmark by even 30% also. And the reason why, because the SISOP, based on its criteria, did not end up only buying the most covered stocks in the market, well understood businesses in the market, but put a lot of money on mid caps, the emerging businesses, which are more secular in nature. For example, we used to have at a point of time Page Industry, Page, Titan, Astral Poly, Acer Motor. You name any of those large mid caps which have moved from small caps to mid caps, many of them are there in the SISOP portfolio. And that's the period when SISOP really delivered very high superior returns. Today, as we move forward, not many options are there, but still from the given universe that we have and the ones which meet our metrics, I think the mid and small cap exposures that we have in our portfolio are the new ones. So we are not betting our, and you see, we are not making our bets on the old angels in the mid cap space. Like a Page is struggling for a growth right now, and Asian Motor is struggling for a growth right now. I actually had Asian Motor for some period in my portfolio, but with this Corona impact, I think auto sector growth is going to be pushed back further. So then we got out of it. So it was already struggling for last 2 years. So growth has become an issue in many of these old angels. So we can always look at their historical financials and then be very happy about it, feel comfortable about it. But will they deliver on the earnings growth that we are expecting from them? That's the key question. From that perspective, we avoided these old angels and we invested into new angels. The new angels in the mid-cap space, as I highlighted to you, are the ones which I said, like Trent, like even in the small cap space, AstraZeneca, Metropolis. Even so, only one which has carried forward then and come back into the portfolio is Astral Poly, where we see growth continuing in the organized pipe market, as well as their entry into the adhesive business can give them additional growth for a longer period. And particularly, they are gaining market share at the expense of weaker players in this market. So even in sectors where there is low growth, or say closer to a 10% sort of a growth, these managements were able to deliver a higher growth because of their market share gain. So some of these names are there in the portfolio. So one is that we are not betting on old angels. We are trying to bring out new angels, and mid cap as a space keeps on throwing opportunity to you to identify new stocks. PA Industry. Okay. So Trent, PA Industry, even Natco Pharma. Natco Pharma is not in SISOP, but it is there in my mid cap portfolio. It's called Sundaram Emerging Leaders portfolio, which has also done well. And so these are the emerging names in the mid cap space, which are which are the new businesses. These are not the ones which have done well, which are not probably the angels of the past, but they are angels of the future. And why we have exposures higher in the mid and small cap spaces? Because that's the area where we find new businesses where the values and the valuations are underappreciated. And if you enter to them, stay invested in them for a longer period, then you make money. Like a PI, it was available at a lower value compared to even Divis Lab. But things were turning out and working. Even Divis Lab has done well now. But if you look at Divis Lab was trading at a substantially higher multiple compared to PI. But we understood that things are turning around for PI, and we invested at a multiple when it was trading at below 20 times P ratio. Today it is trading at as high as even 30 times. So investors got the benefit of P ratio expansion also. So in the mid cap space, since it is less covered and less appreciated from a valuation point of view, you will get more opportunities. And the opportunities are lesser, but it's not that it's not existent. And that's the reason why our endeavor is to find these new angels of mid caps, which will generate substantially higher returns to the investors. They will benefit more because one, the street will take time to understand what we know about this company. Therefore, where the earnings upgrade will happen. And second, the valuation also will go up for them. So they will benefit both. So in my portfolio, you will have 50% of the portfolio, which is more of a compounding nature, where you may not necessarily get a P re-rating happening, but they will benefit from the consistent return that the portfolio generates in terms of earnings growth. And the remaining 50% will be having companies which are not so well understood by the market, which are in the mid and small cap space and underappreciated. Therefore, find a reason to get a valuation re-rating happening. And second, they have ability to even surprise on the earnings front. Put together, these should enable us to deliver that 15% plus sort of a return that the investors are looking for. That's the reason why we have a healthy mix of mid and small caps. And even in the mid and small cap, we are not behind those well-discovered names, right? Like a GMM Fowler today is the most well-discovered name in the street, and everybody is talking about it. But we bought it in our Sundaram Emerging Leaders Fund, mid-cap fund, when it was 1,300 rupees 2 years back. I used to cover this company when I was an analyst, and I know their capability. So when I came over, I bought this company as I looked at what is happening in PI and SRF. Today, everybody is talking about JMM Fowler. But my research background helps me to pick some of these names along with my analyst team, who are very helpful to track these companies, work more to get our understanding better on these businesses, and then keep an eye on this business. Because when you cover a lot of mid and small caps, it is important that you track these companies continuously, because most of the time these managements are not something which they generally are open to speak regularly. So you need to be on top of it through various other ways. And our large research team, which is common for both the mutual fund as well as the PMS, comes really handy when it comes to tracking these companies and evaluating these companies, getting our understanding better on these names compared to what the street's understanding are. And that's the reason why we could find a trend, we could find a PI, we could find AstraZeneca, we could find an Natco Pharma. And that's what the key differentiator that we are bringing to the table. In another ways, everybody is talking about compounding as a story in PMS these periods. The key to compounding is, in addition to identifying new names, and that's what will bring you the higher alpha from a longer term perspective.
All right. Thank you so much for your time, and we wish you all the very best for next 10 minutes. And before we say goodbye to everybody, just one last piece of information that we would want you to give us. This is the operational aspect. Just put your thing on mute. It'll be more clear for audience. Tomorrow we are going to do another very interesting webinar with a director from the CFA Society, where we are going to cover the new regulations which have come up on RIA guidelines as well as the portfolio management guidelines. Particularly from the perspective of portfolio management, there is this new guideline to publish numbers or performance numbers on TWRR basis. So what are your views in this regards? If you could just briefly cover that, and what is the mechanics that Sundaram Asset Management covers when we are talking about performance? Because this entire webinar is all about the performance of your SISOP strategy, which has been very good, right? So over to you in this regards. You're on mute. Kindly unmute yourself.
Sorry. Sorry about it. So one thing I've been very clear right from the time I took over this portfolio management thing, that the challenging thing was that we have a model portfolio approach towards investment, and depending upon the cash deployment for the new investors and also alignment of portfolios for various investors, it was becoming a difficult stuff, and we can see difference in returns for investors. Like if you draw a pie chart, it will look, or if you draw a histogram, it will look like very different from what the model portfolio returns are. Some of them higher, some of them lower, and like these things. So we were very clear along with our operation team and my dealer that we will align all this portfolio to a common portfolio. So one thing we will see from Sundaram point of view is there would be deviations, but these deviations will be less than 5% of the total investor that we are talking about. So which we ensured so that we don't speak a wrong number to the investors, to the new investors or the community as a whole. So we monitor it very closely, but we do it for people who are at least more than 1 year invested, because for some investors, when they come in, we generally take some time before we deploy the entire money into the market. So to that extent, short term, there could be differences. But when we look at, for most of our investors from a 1 year perspective, we run a model portfolio and we align all the returns to the common thing. So when we look at our portfolio level returns versus the model portfolio returns, we don't see very big difference various periods. And this TWRR calculation, I think the strategy level return is the best way to reflect the portfolio performance, because and also an audit of that, it's a very important criteria, because this sector is still not, it's not like a mutual fund, right, where the returns are monitored on a completely system oriented basis. The model portfolio selection itself can be subjective for different investors or different fund houses. So I think it's an important initiative which the SEBI has taken to bring everything on single platform and have a single metric of calculation of returns. And we have been adopting it before itself, and we don't expect a major difference from our return perspective when it is calculated at strategy level or from a model portfolio level. But it's very important before we actually talk about returns for various and compare various PMS companies based on return basis. It's an important initiative, and I think it will put lot of give a lot of comfort for new investors when they look at when we make our pitch from a return perspective.
Thank you, Madan. Kindly put on mute. Yeah. Thank you, everyone, for joining us. It has been very insightful session, and look forward to more sessions. Advice Sense, the name of the series, is named after the name of our wealth management practice. We are very selective in our approach. As you have seen, we analyze 5 P factors, from people to philosophy to performance to portfolio to price, before we suggest any of the products to any of the investors. Hence, we also convey, do not just invest, make an informed investment decision. In this regards, we thank Mr. Madan Gopal Ramu for having given us more than 1 hour of his precious time, where he's covered almost every aspect, which is operational aspect or technical aspect of funds performance as well as stock selection. Thank you once again, and many good wishes to you for the next decade of wealth creation. You're on mute. Manu?
Sorry. Thank you, Kamal. Thanks for giving us this opportunity, as well as thank investors who have taken their time to listen to us. Stay safe and stay healthy. Thank you.
Goodbye.